Welcome to vTalkInsight, Allocator's Lens Daily for March 4th, 2026. The core story today is an energy and geopolitics shock colliding with still solid growth, forcing a rethink of how equities, rates, credit, currencies, and commodities line up in portfolios. Let's start with equities, where the tension between earnings resilience and rising macro risk is most visible. In equities, the immediate backdrop is a broad risk-off tone driven by the Middle East conflict and a sharp repricing in energy. Indications for U.S. and European stocks have been more than 1% lower at times, and Asian markets are also weaker, reflecting fears around shipping disruption and a potential oil supply shock. Europe stands out on the downside. Equity benchmarks there have seen moves described as more than 3 standard deviations, with energy the only sector holding up as banks, utilities, basic resources, and travel names fall together. This pattern is classic for a stagflation scare, where higher input costs and weaker real incomes weigh on cyclicals and rate-sensitive sectors at the same time. Against that backdrop, U.S. equities have been surprisingly resilient. The S&P 500 has absorbed a sharp intraday drop and still managed to close roughly flat, while the Nasdaq has even eked out modest gains, despite oil prices spiking 7 to 9% at times. Under the surface, leadership has rotated hard. Energy and materials are outperforming, and defense stocks like Lockheed Martin, Northrop Grumman, and RTX have rallied as investors seek exposure to companies that may benefit from higher defense spending. At the same time, software and some tech names are under pressure, partly on concerns about artificial intelligence disruption and export controls, and U.S. banks are trading with elevated volatility as higher yields, geopolitics, and questions around private credit exposures converge. The key allocator question is whether the equity market has fully priced the energy and geopolitical risk. There are signals of complacency. Overall valuations remain high, credit spreads are tight, and historical patterns suggest that waves of new initial public offerings often precede lower multiples 6 months out. Yet U.S. corporate earnings have delivered 5 consecutive quarters of double-digit growth, with expectations for another strong year and recent price action hints at a possible bottoming process as negative headlines fail to trigger lasting sell-offs. That leave a scenario range anchored on the duration of the conflict and the level of crude oil prices. If the Strait of Hormuz reopens quickly and insurance constraints ease, oil could give back much of its risk premium, supporting a relief move in cyclicals and international markets. If, instead, disruptions persist and crude moves decisively toward $100 and beyond, the risk rises of a more convex equity correction, led by Europe and parts of Asia that are highly energy import dependent, while U.S. equities may act as a relative defensive given America's net exporter status. Turning to rates, the dominant force now is the inflation channel rather than the traditional flight to safety. Oil and European gas have surged, and that has pushed investors to reassess the timing and depth of policy easing. Expectations for Federal Reserve rate cuts have been scaled back. Markets now see the first cut no earlier than mid-year and fewer total cuts overall, with some measures pricing only a single move this year. U.S. 2-year yields have risen about 10 basis points on recent hostilities, and the 10-year has bounced back above 4.1% as traders reverse earlier haven-driven rallies. The repricing is even more dramatic in other developed markets. European gas benchmarks have risen by 60 to 90% in just a few sessions, and sovereign yields have jumped in response. French 5 and 10-year yields are up mid-single-digit percentages, and UK gilts have seen front-end yields rise around 15 basis points, helped by larger-than-expected government issuance and the fading prospect of an additional Bank of England cut this year. Central banks like the Reserve Bank of Australia are explicitly warning that persistent inflation could force further hikes, reinforcing the sense that policy rates may stay higher for longer, even as growth expectations soften. For multi-asset portfolios, the big shift is that some government bond markets, especially in Europe, are losing their traditional role as reliable diversifiers. Equities have sold off while bond yields have risen, particularly where energy import dependence is greatest, undermining the negative stock-bond correlation that has anchored many allocation frameworks. In the U.S., there is more evidence of range-bound yields, with talk that treasuries may deliver limited capital gains or losses if the Fed stays on hold and inflation remains elevated but manageable. The main risk to that benign view is that higher energy costs embed into expectations and fiscal concerns keep term premiums elevated, lifting the equilibrium 10-year yield even as growth slows. Allocators may want to watch how quickly central banks pivot their rhetoric if energy prices stabilize, because that will shape whether bonds regain some hedging power or remain part of the inflation problem. In credit, there is a striking contrast between broadly healthy public markets and growing stress signals in private vehicles. On the public side, credit conditions for companies and consumers remain described as solid, with strong demand for investment-grade and high-yield paper, healthy spreads, and relatively high covenant quality. Real asset lending and most private credit strategies are still enjoying robust inflows, supported by higher base rates that lift total returns as long as defaults stay contained. Even within direct lending, where rapid capital inflows have compressed spreads, this is still regarded as a small piece of the overall credit universe rather than a systemic weak link. The pressure point is liquidity in large private credit funds. Blackstone's flagship vehicle for private loans has just met record redemption requests of roughly $3.8 billion, or close to 8% of assets, by expanding its tender offer and adding internal capital. Other data show widespread redemption pressure across the sector, even as reported returns remain strong at around 10% and significantly ahead of leveraged loan indices. Over-allocation to private assets by endowments and wealthy investors, combined with the inherent illiquidity of private equity and credit, suggests the next 18 to 24 months could be uncomfortable if redemptions stay elevated and more funds are forced to gate or slow withdrawals. There are also pockets of underlying credit risk that intersect with the current macro shock. Recent sharp declines in software stocks have highlighted how much leveraged lending and private credit exposure is concentrated in that sector, and scenario work suggests that if software defaults reach 10 to 15% with recoveries around 50%, annual returns in some portfolios could fall from 10% to about 5%. U.S. banks, meanwhile, are seeing equity volatility rise on worries about higher yields, geopolitics, and linkages to private credit, even though loan growth and consumer credit quality at larger institutions are still described as solid. Overall, credit markets are not flashing systemic stress, but the combination of tight spreads, liquidity mismatches, and sector concentration argues that conservative underwriting and diversification are likely to be rewarded as the expected shakeout in managers unfolds. Foreign exchange is amplifying the energy shock rather than offsetting it. The U.S. dollar has strengthened sharply, posting its best two-day run since the middle of last year as investors seek liquid havens. The move reflects both the United States' position as a net energy exporter and the scaling back of Fed cut expectations. Traditional havens like the yen and the Swiss franc are underperforming, in part because those economies are more exposed to imported energy costs, blunting their defensive appeal. Sterling is under pressure, slipping around 0.6% at one point, and the euro looks vulnerable given Europe's renewed dependence on liquefied natural gas and low storage levels. A key structural shift is that the usual negative correlation between oil and the dollar has flipped. With the U.S. now a major exporter, both the currency and crude prices are rising at the same time, creating a double squeeze for big importers in Europe and parts of Asia. Higher commodity prices hit trade balances and real incomes, while a stronger dollar raises the local currency cost of those imports and tightens financial conditions. That combination reinforces stagflation risk abroad and helps explain why European and some Asian assets have underperformed U.S. markets as this shock has unfolded. At the same time, debates about de-dollarization continue, but recent stress episodes show that when volatility spikes, flows still concentrate in the dollar and, to a lesser degree, in gold. Commodities sit at the center of today's cross-asset story, with energy in clear focus. Crude prices have surged, with West Texas Intermediate up around 8% and Brent briefly trading above $85, reaching its highest level in roughly 14 months. The immediate driver is the escalating conflict involving Iran and the closure, or near closure, of key Middle Eastern shipping lanes. Tanker movement through the Strait of Hormuz has almost ground to a halt. Crude oil is backing up at Gulf refineries, and Iraq has started shutting production as storage fills, all of which raise the risk of a more persistent supply shock if the disruption lasts more than a few days. The gas market, especially in Europe, is already behaving as if the shock is severe. Production has been halted at Qatar's largest liquefied natural gas facility, which supplies about a fifth of global LNG, and benchmark European gas prices have jumped between 60 and 90% in just 2 sessions, now around 70% above last year's average. At the same time, container shipping through the region has been rerouted or paused, effectively removing around 0.6% of global container capacity and nearly a fifth of global air freight for now. Freight costs have spiked, with some routes seeing shipping expenses rise from around 2% of cargo value to more than 14%, putting additional upward pressure on goods prices alongside energy. Looking ahead, the key swing factor is again the duration of disruption. If the Strait of Hormuz reopens quickly and insurers regain confidence, many expect oil prices to fall back just as rapidly, reversing much of the recent risk premium and easing pressure on inflation expectations. However, if Iran succeeds in regionalizing the conflict, keeps shipping constrained, or targets more infrastructure, crude could move toward the $100 to $130 range that historically threatens global growth. On the metals side, gold and gold miners remain favored as hedges against both geopolitical escalation and doubts about central bank control over inflation, and flows during recent shocks confirm that, alongside the dollar, gold is still treated as a core safe haven even if it can underperform temporarily when investors rush to cash. Stepping back, the cross-asset picture now revolves around an energy and logistics shock that is pushing inflation back to the forefront just as growth and earnings remain resilient, especially in the United States. Equities are caught between those forces. U.S. indices show resilience and strong earnings, while Europe and parts of Asia bear the brunt of higher oil and gas, with pronounced sector and regional dispersion. In rates, the inflation channel dominates, with cuts pushed out, yields higher, and some European bonds losing their diversifier status. Credit overall is still robust, but private funds face liquidity and concentration risks. The dollar and oil rising together tighten conditions for importers and reinforce relative support for U.S. assets, while commodities, led by crude, European gas, and gold, remain the main transmission mechanism from geopolitics into macro and markets. For allocators, the crucial variables to watch are the duration of Middle East disruptions, the path of policy rhetoric as inflation data reflect higher energy, and any sign that private credit stress is spilling into the broader system. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.